In this lecture, we're going to finish up the remaining topics in Chapter 11. So there's just sort of a hodgepodge of different topics. The first one is I want to look at the difference between a stock dividend and a stock split. So let's assume that we have a stockholders' equity section of a balance sheet with these beginning balances. And we're only going to have paid-in capital retained earnings. I'm going to ignore treasury stock in this illustration. So what I want to do is let's take, these are the balances before any dividend or any stock split. So let's go to the next page because we're actually going to compare three different scenarios with the original. So in the original, the common stock account, and again that'll be in dollars, was $10,000. The additional paid-in capital was $240,000, so a big number. Obviously, the stock sold a lot more than above its par value. So total paid-in capital, again, is a dollar amount, $250,000. And then we had retained earnings, $50,000. And then if I add up the paid-in capital and the retained earnings, those will total $300,000, and that's all I have in stockholders' equity. So I'm just taking these numbers and putting them over in our table. Now I also want to look at how many shares are issued. And in this, it tells us 10,000 of the 40,000 authorized by the state, we have actually sold or issued 10,000 of them. And we can double check that number because 10,000 shares at $1 par would be $10,000. So we can see the balance represents 10,000 shares at $1 par. So let's go put the number of shares outstanding is a number, so 10,000. And the par value per share is only $1. So that's the scenario that we start with. Then, in our narrative, the board is considering either a stock dividend or a stock split, and we're going to look at three different scenarios. So, in the first one, the board declares a 10% stock dividend. Well, if there's a stock dividend instead of a cash dividend, the question is, what's the cost of the dividend to the company? Because when it's cash, that's black and white. Whatever we're writing the check for is the cost. But if we're issuing stock instead of cash, it's a little bit more challenging to figure out what's the value of that. Because what's going to happen is the total market value of the shares outside the company, right? The market price, the total market value of all the shares combined, not necessarily individually, or it might be individually, but certainly we're going to increase the market price of all of the shares collectively will go up. So the Financial Accounting Standards Board made a rule, and it looked at if there's small stock dividends where we're only, we're going to increase, a small increase in supply in the market. So if we just put a small amount of stock, we increase the supply of stock in the market just by a little bit, then that's really going to, not necessarily affect the market value per share, but it will increase the total market value of all shares. So because of that, if it's a small stock dividend, cost is going to be market value. So we're going to use market value to record the cost of the dividend. And so in the data declaration, the market value is $30. I am going to bypass the dividends account and just go ahead and reduce retained earnings directly in this demonstration. So we know dividends reduce retained earnings. I'm going to bypass having a dividend account and just go directly to retained earnings. So if there are 10,000 shares outstanding, right, issued and outstanding, only the outstanding shares receive a dividend. And we're going to issue another 10%, then that tells me we're going to issue 1,000 shares for this dividend. And then the cost of those will be the market price, or the market value of $30 a share. So the total cost of this dividend will be $30,000. So I'll reduce retained earnings for the full cost of the dividend. And then we have to record the issuance of the stock. So 1,000 shares of common stock will be issued. So we increase the common stock account. And again, if it's 1,000 shares, par value is only $1. So that'll be $1,000. Okay, and then we also want to increase that additional paid-in capital common stock account to balance that out, $29,000. Okay, so in effect, what we have done is we've decreased retained earnings $30,000, increased the common stock account $1,000, and increased the additional paid-in capital for the common stock $29,000. So let's take the impact of this and go to the next page and factor that in. So what we did is we reduced retained earnings. Okay, let's go back. We reduced retained earnings $30,000. So 50 minus 30 would give us an ending balance. Instead of setting up a T account, I'm just solving for the change in the balance. Retained earnings would go down 30. And then the common stock account would go up 1. The additional paid-in capital will increase $29,000. So the common stock account will go up $1,000 to $11,000. The additional paid-in capital will go up $29,000 to $269,000. All right, so let's kind of draw our line because we add the common stock and the additional paid-in capital for the common stock to get total paid-in capital. So it's going to grow to $280,000. And so when I add my total paid-in capital with retained earnings, I'll get $300,000. Okay, number of shares. Remember, we issued 1,000 shares, so the number of shares grew by 1,000. Par value, though, stays at $1. And so we can see then 11,000 shares at $1 give us this $11,000 balance in the common stock account. Okay, now let's look at the second possibility. In the second possibility, we issue 100% stock dividend. Well, that's a lot, we're putting a large amount of stock into the market. So we are greatly increasing the supply of stock in the market. If you flood the market, then often market prices will go down, right? If you oversupply the market, prices go down. Basic economics of supply and demand. So because of that, so for large stock dividends, the question for cost is that we know market value will go down. The question is we don't know how much. So since we don't know how much on the day of the date of declaration, the accounting rules just say use par value. It may not really be a relevant number, but it is a reliable number. So we don't really have much else to use. Okay, so let's recall. I'm going to go back to the original data. So, here's our original, and we're looking at case 1. And then we're going to go back to our original data. What if case 2 were to occur? And we go back to our original data. What if case 3? So it's case 1, or case 2, or case 3. It's not and, but or. Okay, we have 10,000 shares. If we issue another 100% of those, we're going to issue 10,000 more shares. So we know that dividends reduce retained earnings, so retained earnings will go down. We're bypassing the dividend account. And we're going to issue common stock. And we use par value. So we're issuing 10,000 more shares. We call par value. Par value is only $1. So $10,000 is the cost of this dividend. So we debit retained earnings, 10 grand, credit common stock, 10,000. Okay, now let's go look at the impact. We reduced retained earnings 10,000, we increased common stock 10,000. So go back to your original data. We're going to reduce retained earnings $10,000. So 50 minus 10, it'll go down to $40,000. The common stock account, we start with 10,000. We're going to increase it another 10 grand. So it'll grow to $20,000. Nothing happened to the additional paid-in capital account, so it'll stay at its original $240,000. So in terms of the accounts, common stock plus additional paid-in capital will now be $260,000 when I add those together. And then I add my paid-in capital and retained earnings, so I add these two together, and again I get $300,000. Number of shares, we started with 10,000. We issued another 10,000 shares. So now we have 20,000 shares, and nothing happened to par value. It's still $1. So 20,000 shares at $1 is $20,000 in our common stock account. The last thing is to split the stock 2 for 1. So kind of in essence what we do is we call in the 10,000 shares. It's as if we pull these 10,000 shares in and we will split it. So what was 1 will now become 2. So we're going to double the shares of stock, 20,000 shares. So again, if this is 1 share of stock with par value of $1, we're going to pull it in, and it's as if we cut it in 2. So after that, there will be 2 shares of stock, each for 50 cents. So 2 for 1. So we pull in this 1 share of stock, and we split it into 2. So it's still a total of $1 par, but now it's 2 certificates, 2 shares of stock. So we're going to have 20,000 shares, and par value now is 50 cents. So I take $1 par, and I divide by 2 to get my 50 cents par value. Okay? All right. There is actually no journal entry for stock splits. Okay? There's no journal entry for this. And here's why. After we split it, there will be 20,000 shares of stock. The par value is now 50 cents. 20,000 shares at 50 cents is $10,000. Well, let's go back to our original data. That's what's in the common stock account already. We already have a balance of 10,000, and that's what we want it to be after the split. So there's really no journal entry other than a memo to state shares have grown to 20,000 and par value is now 50 cents. Okay, so since there's no journal entry, common stock stays at 10,000, additional paid-in capital stays at $240,000. Total paid-in capital stays at $250,000. Retained earnings stays at $50,000. And so, adding those two together, total stockholders' equity is $300,000. So I'll double rule everything at the bottom, our total stockholders' equity. Okay, so we're looking at comparing if we have stock dividends versus a stock split. In all 3 cases, let's look at what was common. In all 3 cases, total stockholders' equity stays the same. So that's one observation. Whether we have a dividend or a split, either way, total stockholders' equity stays the same. What differs is the makeup of stockholders' equity. So if we have these 2 areas or sources of stockholders' equity, with the stock dividend, right, we have an increase here, 250 to 280, or 250 to 260. And we have a decrease in retained earnings, 50 to 20, or 50 to 40. So when there's a stock dividend, in essence, we take numbers out of retained earnings and increase the numbers in paid-in capital. And it's not cash, right, because these are just balances. So there's no, right, we had no journal entry up here that had anything to do with the cash account. So it's not cash. It's just taking numbers out of retained earnings and putting those into additional paid-in capital. And with a stock split, there's no change in those sources. Paid-in capital stays the same, retained earnings stays the same. So there's no change. So the point is, in particularly, companies often are looking at a 2-for-1 stock split and a 100% stock dividend, because the 100% stock dividend, right, doubled the shares of stock. The 2-for-1 stock split also doubled the number of shares of stock in the market. So why do companies have a 100% stock dividend or a stock split? What's the motivation, especially with the stock split? Stock splits reduce the market value per share. Well, why would I want to do that? Well, what if my market value per share has gone up to $100,000? I mean, how many people can afford to buy one share of stock at $100,000? Now, if it's $100, I'm going to have a whole bunch of people that can purchase it at $100,000. But $100,000, not very many people can afford that. So stock splits are used to effectively reduce the market price or the market value per share. Likewise, 100% stock dividends are also used to reduce the market value per share. Both of these are tools to do that. In essence, the only difference between those two, because they double the number of shares in the market, is the accounting. And so here's the question: why would I want to shrink my retained earnings? I shrink right here. We shrunk our retained earnings. Instead of 50,000, it's only 40. Well, if I shrink my retained earnings, that allows me to limit the amount I can pay in future dividends. So management, if for some reason management wants to limit the amount of dividends they can pay in the future, they may opt to structure the transaction as a stock dividend instead of a stock split, if they want to accomplish this. Okay, that's the first topic of this lecture. Second topic is for preferred stock dividends. And I have mentioned already, preferred stock is kind of a hybrid security. Right? It's a little bit of a hybrid. It kind of looks like debt, but it also looks like equity. Because we know, the debt, preferred stock dividends, right? That's where we take, par value or a face amount. So to get the dividend, we take the face amount, which is the par value, times the dividend rate on the stock certificate. So, but in substance, this is actually an interest rate, and this is principal of debt. So the dividend is calculated much like interest, so it kind of looks like interest. Now, preferred stock can also have another characteristic. It can be cumulative, which means that the preferred stock dividend will accumulate over time. Well, how does that play out? Well, let's look at this scenario. If we have 10,000 shares, $10 par, preferred stock. So again, par value, right? 10,000 shares at $10 par is $100,000 par value of stock. But it actually sold for $19. So it sold at $9 above par, right, for 19. So $9 in excess of par value for 10,000 shares is our $90,000. So we would have these two balances in the accounts for preferred stock. Cash would have come in of $190, right? That would be our debit, and we would credit each of these accounts for these amounts. Now, on the stock certificate, it has a 7% annual dividend. So we would take par value, which is $100,000, times that dividend rate, the 7%. Of course, I could take it times 1 for 1 year to get the annual dividend of $7,000. So the annual dividend for preferred is $7,000. So let's do this table. So if the board of directors declared a $100,000 dividend, First, we would give $7,000 of that to the preferred, and then anything left over goes to the common shareholders, the remaining 93. But what happens in the following year if we only pay a $5,000 dividend? Well, all of that will go to preferred, and nothing will go to common. Then we will have what we call a dividend or dividends in arrears, right? That we are in arrears, we're behind on our dividend for the preferred shareholder, right? The annual dividend is $7, but we only paid $5, so we are short $2,000 in dividends. Now this is not a legal liability, right? Dividends are not a liability until they are declared. So what the accountant will do then is merely disclose dividends and arrears in the notes to the financial statements. So we want the reader of the financial statements to know, we want them to know about the dividends and arrears, but it's not a legal liability, so we don't make a journal entry for the $2,000. Now the following year, what if $7,000 is paid? What if $10,000 is declared as a dividend? Well, the $2,000 in arrears gets paid first, and then the current dividend of $7,000. So for the preferred shareholder, they'll get $9,000 before common shareholders receive anything. We pay the dividend in arrear, we pay the current dividend, and then whatever's left over, which in this case is $1,000, goes to the common shareholder. If in the next year no dividend is paid, then obviously nobody gets anything, and we are short or have dividends in arrears for the preferred shareholder of $7,000. Then in 17, if 20 grand is paid, so we'll pay, right, this dividend arrears gets paid first, and then the 2017 dividend. So the preferred shareholders will get $14,000, and then the common gets what's ever left over, the $6,000. So that's how dividends, when preferred stock has a cumulative feature, and again, not all preferred stock is cumulative, but if it does have this feature, that's how dividends are determined. Okay, then our last topic for this lecture. We know, big picture, that assets can either be financed with debt or equity. And in Chapter 10, we looked at a ratio. We looked at debt to assets, and we measured financial risk. You know, that there was more risk financing with debt because you have to pay it back and you have to pay interest. If we finance with stock, there's not a whole lot of risk because dividends are optional and we don't pay back par value of the stock. So in terms of just financial risk, there's more risk financing assets with debt. But we want to look at a little deeper into that whole concept. So, you know, why would a company then ever want to borrow money? And there is a reason, so let's look at it. I'm actually going to have us do the current ratio and debt to assets. Here's the original data from above. So I just did our short-term assets, 100,000. Let's do the long-term assets, 225. Current liability, 65. Long-term debt, 160. And stockholders' equity of 100. Now, there's going to be two scenarios. One, we're going to look at a rate. This company needs to raise $100,000 in cash. We're going to look at the first scenario, what if we borrow to do that? So in the first case, they're going to issue bonds. So what if they borrow by issuing bonds? So if they do that, right, cash will come in. Right, so we're going to, if we borrow money, cash will go up, which is our assets, and bonds payable will also go up, in both cases, $100,000. So cash is a current asset. It'll grow to $200,000. Follow? Cash will come in of $100,000. Our current assets will grow 100 grand. Bonds payable, it's a long-term liability. So we're going to owe $100,000. Okay, and then likewise, we're going to increase bonds payable, right? Cash goes up 100,000, bonds payable will go up 100,000. That's a long-term liability, so that's going to grow to 260,000. And I'm just leaving the thousands off down here so it was easier to write. So nothing would happen to non-current assets and current liabilities or stockholders' equity. Those would all stay the same. So I still have 425 here, 425 over here, and we're in balance. Okay, and then the other possibility is issue stock for 100,000. In that case, again, we would increase cash 100,000, and on the other side, common stock would go up 100 grand. So let's go down here. Again, the original data, if cash goes up 100,000, it'll grow to 200. And then, let's go over to stockholders' equity. If we issue 100,000 of common stock, stockholders' equity will go from 100 to 200. And then non-current will stay at 225. Current liabilities, nothing will happen. Those will stay at 65. And non-current liabilities, nothing would have happened there, and it'll stay at 160. So again, I'll have 425, 425, and we're in balance. Okay, so this is what, here's our original data. If we issue $100,000 of bonds, or if we issue $100,000 of stock. So debt or equity, what difference does it make? So either way, assets go up 100,000. Do I want debt to go up 100 grand, or stockholders' equity to go up 100,000? Okay, remember our current ratio is taking current assets divided by current liabilities. So if I do that with the original, I'm taking current assets of 100 divided by current liabilities of 65, and I will get 1.54. If I do that under the bond scenario, I'll have current assets of 200,000 divided by current liabilities of 65. It'll be 3.08. And lastly, if we look at common stock, with that alternative, current assets are 200,000, current liabilities are 65. We'll also have 3.08. So here, whether I issue bonds or stock, it has no impact on the current ratio. So recall, we are measuring liquidity there. How quickly can the current liabilities be paid off? So here, for every $1.54, we have $1.54 of current assets for every dollar of current liabilities. Here we roughly have $3.08 for every dollar of current liabilities. So we have 3 times as many current assets as current liabilities. We're very liquid in these last 2 scenarios. We have lots of current assets to pay off the current liabilities. Debt to assets is just what it says. We would add up our total liabilities and compare it to our total assets. So in the first scenario, if I add up debt, so 65 plus 160, if I add that up and divide by my total assets of 325, you should get something like 69%. And here I'm looking at total liabilities, and I'm dividing by my total assets. So again, I am taking this 225 and dividing by 325. If I issue bonds, my liabilities will grow. So if I add these 2 up, divide by total assets of 425, you should get something like 76%. And that makes sense because we borrowed money, right? We issued bonds, we borrowed more money, so we're financing more heavily with debt than originally. If we issue stock, we did not change our liabilities. Those will stay at the 65 and 160, so I add those together, divide by 425, and we actually will see a drop, 53%. So if I finance with equity, then my percentage of debt will go down. And we had talked about earlier, if it's 76%, that will carry more financial risk. And the reason more financial risk, and again, because Our interest and principal payments are a fixed cost in the future. They're a fixed cost. I don't have an option. I have to pay back principal and I have to make interest payments. So if I issue bonds, I will take on more financial risk. Well, why would a company be willing to do that? So let's look at other factors in all of this. All right, so let's look at in the income statement, income before interest and taxes. Get it? Income before interest and taxes. So let's say income before interest and taxes, let's say it's $50,000. So whether I issue stock or whether I issue bonds, I'm going to have this kind of income if I disregard interest and I disregard taxes. If I issue stock, I didn't borrow any money, so I don't have interest. So income before taxes would be $50,000. We're going to assume a 30% tax rate. So 30% of $50,000, my income tax expense would be $15,000, and my net income then would be $35,000. Okay, now if I do have stock, I don't have to pay interest, but I do pay dividends. So we're going to assume that we do pay dividends, even though I don't have to pay dividends, but most companies, from a political perspective, usually feel compelled to pay dividends, although legally they don't have to. So if I take net income, and if I'm looking at retained earnings, we know that net income increases retained earnings, dividends reduce it. So then the impact on retained earnings. So I know net income less dividends, our retained earnings for this year will grow by $25,000. So retained earnings will grow. I'm not doing the ending balance, just the change in retained earnings. It'll go up by 35, down by 10, an overall increase of $25,000. Okay, let's go over to bonds. If we have bonds, and I just said, let's assume interest is $10,000, then income before taxes will be $40,000. And of the $40,000, again, I'll have to pay tax of 30%. So now I don't have $15,000 of income tax expense. I only have $12,000. But my net income is going to be smaller, $28,000. Okay, now let's keep going. If we borrowed money and we didn't issue the stock, then we would have interest, but we wouldn't have dividends. So net income causes retained earnings to go up. Dividends cause it to go down. Now the overall increase in retained earnings under this option is $28,000. And right now you're going to be having an aha moment for the shareholder. If I only look at this from the shareholder's perspective, do I want retained earnings to go up $25,000 or $28,000? Yeah, I prefer this. So my rights, stockholders' equity will go up more if I issue bonds and I take on debt. Remember return on equity when I solve for that? That is taking, net income minus my dividends and divide by stockholders' equity. And by the way, that's preferred stock dividends, and we don't have any never mind. Okay, so net income minus dividends, 35 minus 10, so we would have $25,000. Stockholders' equity under this option. If I issue stock, is $200,000. But keep in mind, retained earnings went up 25, so it's actually $225,000. Right? It was $200,000, but that's just the common stock account. Now we're going to have $25,000 in retained earnings, so a total of $225,000. So that's going to give me a return of something like 11.1%. Over here, I'll have the $28,000 net income minus dividends. Stockholders' equity was 100, and it's going to go up 28. And we did have 100,000. That was common stock. But retained earnings will go up 28,000, so 128,000. And that'll give us a return of 21.9%. Woohoo, that is outstanding. Look at the big difference of return on equity. And again, this is only looking at the shareholder's perspective. So this is called financial leverage. This whole tool is called financial leverage. It is using debt to leverage a higher return on equity. So if we use bonds and borrow money, finance assets with debt, it does carry more risk. But it enabled us to have a higher return on equity. But I do want to emphasize there's risk with this. There is risk with it. And while we can have a higher return on equity, if things go south, we will have a larger loss on equity as well instead of return. So it can go both ways. And again, so the willingness to take on additional risk with the opportunity to generate a higher return on equity to our shareholders than otherwise. And again, it's a very limited bird's eye view, a very limited view of only looking at this from the shareholder's perspective, not the company-wide perspective. If I wanted the company-wide perspective, I use the return on asset measure.